Welcome, everyone. Thanks for joining us. We are here because the Fed is meeting on July 31st, and they look like they're going to cut rates. And I think we're going to steer away in this conversation from predictions and just assume that they're going to cut 25 basis points. We have a great group of folks here to talk through this. We really want to talk through the case for, the case against, what does it mean for the Fed's reaction function? Is the Fed going to be cutting more? We have a great panel: Julia Coronado, George Pearkes, how do I say your name? Pearkes, Conor Sen, and Skanda Amarnath. And I'm just going to be moderating. And this came about because we were basically BSing online about this, and it felt like, why not take it from online to webinar, share it with more people, get a little bit more in depth. But I say that because we've thrown this together at the last minute. So if there are any logistical problems or any other problems, blame it on me, because we really threw this together at the last minute, and these folks have just been generous enough to experiment with us with this kind of format. So let me, I'm not going to do full introductions, but let me start with, maybe I'll start with Julia and say, should the Fed be cutting rates? What is the pro rate cut best case argument?
So I think the answer is yes. And to me, there's a dual motivation for this rate cut. One is that there are downside risks to what is still a decent outlook. We expected the economy to slow. It's slowing. It doesn't look like so far it is slowing more than expected. But the global risks, the risks that are being inflicted by the US on businesses in the form of uncertainty around trade policy, a very pronounced global slowdown led by China, all of that suggests downside risks to this outlook. We know that the lessons from being close to the zero lower bound is that you don't wait around for those risks to actually materialize in the data before taking action. When you have limited ammunition, you act more proactively than the Fed has in the past. So that's the insurance cut. That's the insurance aspect of this rate cut. The other is the persistently low inflation, which is informing us all about what is the neutral Fed funds rate, which is lower. And those two things actually interact. So inflation and inflation expectations are lower than ideally would be the case at this stage of the cycle. We would like to see inflation above, slightly above 2%, inflation expectations higher than they are. And if you actually get hit with a shock, inflation is much more responsive to the downside than it is to the upside. So the risk is you will get a self-reinforcing move lower in both inflation and inflation expectations. Think Europe, think Japan. The Fed wants to avoid that kind of risk, that outcome. And so the dual motivations mean, why not recalibrate policy proactively and lower rates a bit and see how it goes.
On the global picture, is the global picture worse now than it was 2016, 2015? I mean, in a period where we were signaling, we were going to be raising rates, or earlier, 2011.
So the 2016, right now it looks like in just terms of, say, the global PMI, we're a little bit worse than we were in 2016. The Fed similarly recalibrated in 2016. So remember, in December 2015, they were saying we're going to do 4 rate hikes each year. They ended up doing 1 in 2016 at the end. So there was a similar sort of recalibration of the baseline for monetary policy to a more accommodative stance in that instance. It did serve the desired role of ensuring the global economy, global markets, against a more pronounced slowdown, a more nonlinear transmission into confidence. So I think that that's not a bad analogy. And yes, we are as bad, if not slightly worse than, and in fact, more of it is it's a more broad-based That one was very pronounced, China, EM,
Mm.
energy sector. This is a little bit more broad-based across sectors, and it's transmitting into the US through earnings, business investment, even real estate. The number of foreign buyers and investors has been shrinking, so that while you get a domestic response from lower mortgage rates, you're actually seeing housing is not contributing to GDP. So we are seeing some transmission. So far, that's been moderate, and the consumer is doing its job, being the resilient consumer. But that's the reason for being preemptive, is to short circuit that transmission into the broader domestic service sector.
Got it. And everyone will be shocked that Adam Ozimek has our first comment in the chat about the output gap. But before we get to the chat, Skanda, do you want to add anything to Julia's story? Julia, is it fair to say your story is consistent with the story the Fed is telling overall? Yes?
Yeah, I think like with the people on the FOMC that are advocating a cut, this is the message that they're delivering. So yes.
Skanda, do you want to add?
Yeah. So so just to add to Julia's case, I think that it's also worth thinking about what the Fed's decision means relative to what's actually priced into the market, and sort of what kind of innovation are they actually trying to inspire through market expectations and financial conditions. So from the standpoint that we're priced for a rate cut, there's some future cuts as we go further out on the Fed funds futures curve. But we have to ask, if the Fed is not going to cut at the July meeting, what are they actually trying to create? Are they trying to create a hawkish innovation that slows down the economy? Is that really what they're trying to engineer here? I'd say the risks are skewed to the downside. Mostly, I'd say there are probably two major factors in terms of why the outlook is not quite what the Fed thought it was, call it 9 months ago. One is that global growth was slowing faster than they anticipated. I chalk that up mostly to China, China's growth slowdown, and really the spillovers of that have been more pronounced than even what you see from the China growth momentum, maybe decent, but the spillovers to other economies, especially in Europe, seems to be more pronounced. So that's the other factor I'd say at play for global growth, and then I'd say fiscal policy not being as supportive as they anticipated. So as far as like what they want to engineer now, I think they would like to keep a pretty stable growth outlook, and we have already priced in, like the easing in some ways has already happened, right? We've already priced in more cuts. It also has kind of helped to stabilize the dollar and make sure it doesn't appreciate too quickly. And so both of those are also supportive of the outlook. So if they want to maintain the current outlook priced into financial conditions, then the cut seems warranted. So I would stand by that case.
So you wrote a now famous Medium post in was it June, early June?
Yeah, so it was in early June after the weak payrolls print, and we had financial conditions that were largely being supported by the Fed at that point.
But you made an argument about the labor market slowing, and so this morning we had jobless claims at 206,000. Good jobs report. The last jobs report was a good one. Is there still a good case the labor market is slowing, and we need this cut, not just for the reasons Julia said, but also because we have an employment situation that needs to be addressed?
I think the rate of labor market progress, if you look at non-farm payrolls, you'll say there's not really been much of a run rate change aside from like a couple of weak prints, mainly the weak print from the May employment report. If you look a little bit broader at the household survey, which is a broader definition of employment and tends to have actually more cyclical variation, you have seen weaker job growth itself. Jobs are maybe on the margin still growing, but the pace has definitely slowed. And then if you look at the broader measures of gross labor income, especially from what we got from the quarterly, the QCEW update, that's also pointed to the fact that labor market momentum has slowed down, both in terms of nominal and real rate of progress. And from those are the two reasons why I'd say, yeah, the rate of progress has slowed down at the very least, and so we're closer to that sort of point where progress may be stalling out. If you look at the prime age employment rate as another example of where we haven't seen progress more recently. So
cool.
Yeah.
Conor, you want to take the first shot? Tear these arguments apart. Give your best case against the, if you feel it, your best case against cutting rates this meeting.
I actually think they sort of have to cut rates 25 basis points next week. And the only reasons I say that are, first, I mean, the market's priced for it, and that by itself might not be enough. But then the Fed, in its commentary this month, has basically told us they're going to do it. And so at this point, if they weren't going to do it, then it's sort of like, okay, well, what are you trying to jerk us around for? I think the data case is much weaker. I think especially if you focus on U.S. data and the mandate, as they put it, like sort of, even though we're going to have a softer growth quarter this quarter, probably looking like GDP in the ones. If you look at survey-based measures of consumer confidence, the consumer keeps chugging along. We are still, I think the trend is still above trend growth, even if you have a quarter that's below for a bit or two. And, sort of global factors, like Julia talked about, in 2015, 2016, markets were much more stressed. Credit spreads really blew out, and credit spreads were kind of signaling recession back then, whereas that's not the case today. Stock markets are at all-time highs. So the financial conditions case, I guess, agreeing with Skanda, it's, you could argue the Fed is sort of propping them up, and the market is priced in the cuts, and maybe that's why it's happening. But I don't think the case for hikes are there, but I think in terms of, I would say the strongest data case for cut is probably a yield curve based case where, if the Fed is sort of, I think, pivoting away from trusting a Phillips curve based view of the world where they believe that above trend growth will feed into wage growth and inflation down the road, and sort of more believing in a yield curve based model of the world where even if you can't see the downside risk or the recession, if any part of the curve is inverted, that's something to take seriously, especially as we're close to the zero low bound. So, I don't think a cut this month necessarily makes sense, especially if they ever have to turn around and hike down the road. But I understand the reasoning for it at the same time.
So is that the big risk of, well, let me ask, is there a counterfactual world where they hadn't teed this thing up for a cut and we were in a better position for you to say,
I think until the Powell Humphrey Hawkins testimony, I still thought that no cut was a reasonable thing for them to do. But once he said, everything he talked about was downside risk, like, okay, well, this is what they're going to do.
Right. And the risk is they'll have to reverse course too quickly, or like the risk is not like an overheating scenario. The risk is they're not.
Yeah, I think, sort of having to potentially reverse at some point down the road, let's say even one hike in 2020, what a shift that would be from how markets are currently priced and what that would do to financial conditions. And I guess you could say that they only would do that if things were really, truly overheating. And so maybe that's not a big deal. There's sort of a lingering case, sort of like they're letting the market bully them into moving, that, if the market's priced for something, they're just going to do it, even if the data doesn't support that. But right now in July 2019, it's kind of a weak argument, I think.
George, what do you want to add to this picture?
I totally agree with Conor. At this point, their communication strategy has basically been to really smooth the landing on whatever they're going to do, whether it's going to be hikes, whether it's going to be cuts. And that's something that they've been working very hard on throughout this entire tightening cycle. So, really, I think what happened last week is the most instrumental thing about their communication strategy. Williams came out and gave this speech where he's talking about how you need to be aggressive and ease early. And it's a very clear signal that, like, to the markets that we've already got one cut 100% price, another 25 basis points at the July meeting may be on the table as well. The New York Fed then had to come out and issue a clarifying statement saying, whoa, we didn't actually mean 50 basis points. I mean, that was the subtext of the statement. Basically, the Fed has groomed the market for what's coming, which is a 25 basis point cut. They've wanted to make sure the market's prepared for that. The problem is the market is pricing 4 cuts over the next year. The market is pricing full-on pre-recession type behavior from the Fed, and being really aggressive about it. And so the Fed hasn't calibrated its communication strategy to account for that. And I think both what Skanda and Conor said make a lot of sense. If they were now to take that cut off the table and not deliver it, that's maybe the worst thing they could do, just in terms of creating confusion and creating disruption in financial markets, both credit markets and in rates markets. there are some really big differences from prior global slowdowns. So for instance, like 2015, 2016, in July 2015, the dollar was up over 15% year over year. We're now under 3% and falling. We're at 2.9% year over year and falling on a trade weighted basis. The U.S. manufacturing sector, core capital goods orders, core capex was basically down on a three-month rate. We're up. We've been up basically since 2017. Specific sector shocks are much more modest this time around for the U.S. economy, less so overseas. And there's a bunch of idiosyncratic factors, whether it's auto regulation in the EU, slowing auto markets in China, the decline of Turkey's current account deficit very quickly, which has had a huge impact on Germany, but less so in other Eurozone manufacturing sectors. There's a lot of idiosyncratic stuff that was much more clear-cut in terms of being, a broad global driver in the last slowdown we saw, which was 2015, 2016. So I kind of disagree that the Fed, if in a perfect world, the communications issue aside, I would argue that there's no need for the Fed to cut right now based purely on data and where things are. The thing is, though, I think that when you hear people say, oh, well, the Fed doesn't need to provide easier policy, too many commentators don't talk about it from a risk-reward perspective. If the Fed cuts now, it's hard to imagine a scenario where they create a massive problem by doing so, whether it's through over-leveraging of various parts of the economy or through an overheating labor market, too much inflation, whatever. The underlying data just doesn't support that there's a huge downside risk to cutting now. So in that sense, I don't necessarily think a cut right now is what has to happen for reasons, based on the economy slowing, based on the labor market slowing, based on the global economy. But at the same time, I can definitely appreciate that the risk of what happens if they do cut and it's unnecessary is much lower than the risk of them needing to cut now and not doing so.
Julia, Conor and George are telling a little bit of a different story about the global picture. Core capex, dollar. Conor talked about credit spreads. What do you think? What's your response?
There are different composition of this slowdown to the last one. Again, that was very commodity led. It was China sort of squeezing out commodity deleveraging. That led to a crash in commodity prices, the dollar soaring, et cetera. So there was a lot of EM commodity related hit from that global slowdown. This one is actually, we're later in the cycle. There is less of sort of tailwinds from pent-up demand, be it here or in Europe. And the composition of the slowdown is much broader across categories of investment. It's not as sharp and pronounced, but it is more broad-based. Across the earnings, for example, technology is an area that is reporting negative earnings for that subsector of the S&P 500 for this year. Yes, there are differences, but that doesn't mean that the risk isn't still pretty clearly to the downside. The global demand picture is one that it's going to be slower if we don't get some sort of stimulus. And I don't think the Fed is thinking right now that they're going into a full-blown easing cycle on a recessionary type of dynamic. But it is very clear that a recalibration in monetary policy is warranted, both by the demand dynamics we're seeing globally, as well as the inflation dynamics. So I think it's interesting that neither Conor or George have really highlighted the inflation dynamics, which both headline and core inflation are very subdued.
Far from the Fed's,
ideal outcomes at this stage of the cycle. So that is, again, interacting with these more cyclical considerations in a way that makes that recalibration, it just lowers the bar for that recalibration, makes it more appealing, because what you're going to achieve is a longer cycle and maybe retain some of the basic inflation dynamics that the US still has, that Europe has lost and Japan has lost, and they've lost the policy space that goes with it. So it's protecting that policy space as much as anything else.
George, you were going to say something?
Yeah, just on the question of inflation. So Julia's absolutely right. Year over year inflation is very very weak relative to target. So for instance, core PCE is 1.6% year over year versus a 2% target, and it's been behind for a long time. So arguing there should be some catch up makes a ton of sense. But I think it's worth pointing out that higher frequency inflation rates do not look like that at all. Core PCE was 2.3% annualized in its most recent report, which was May data, if I remember correctly. June core CPI, most recent report, which is June data, 3.6% annualized. Both are at 2% or higher on a 3-month annualized basis. So we've seen some of that transitory inflation weakness wear off. Now, again, that doesn't mean that, we need to hike to get rid of this, above target, high frequency inflation. But it's an example of, I don't think the inflation picture justifies a cut here, even if you do cut it, that doesn't mean we're going to have runaway inflation, if that kind of makes sense.
So I agree with your characterization. We do a lot of bottoms up sectoral analysis on inflation, and we fully agreed with the transitory description of some of the weakness earlier in the year and have expected this rebound in the higher frequency measures. This rebound is also transitory. However, there's a lot of changes in source data, changes in seasonal adjustment, methodologies that's going on under the hood in the CPI. You want to look through both the transitory weakness and transitory strength. And on that basis, we are still trailing 2%. It's just going to be very hard to get a symmetric 2% outcome given what we're seeing in inflation dynamics. So, I think that it's, again, not an emergency rate cut. This is not a cut to forestall a recession, but it's also hard to argue that policy is well calibrated if you are persistently falling short of your goal, your mandate. And the labor market still looks far from overheating. There's just not a lot of wage growth. The labor share of GDP is still extremely low. So it's just hard to say that a recalibration isn't a good risk reward. And you yourself said that, risk reward, it's a pretty easy call. There's enough, both from the risks to the outlook and the persistence, the cyclical signals that you're getting from the labor market and inflation, say, recalibrate policy and make sure you extend this expansion as long as you can.
I think if I could jump in real quick, and I think your point, and this is sort of what George is talking about, since we are priced for about 4 rate cuts over the next year, the communications on their part has arguably been short because, I think sort of framing it as a recalibration is very helpful. But I think markets are going to say, well, we're getting 1 rate cut. Once you get one, a whole bunch more coming down the pipe. And that, from a long-term sort of disruption standpoint, that would be something I would be worried about. If it's only 1 cut, then the market is actually, down the road has to really recalibrate, and that's going to mess with financial conditions.
Yeah, and I think communication is going to be challenging. And we expect 2 cuts, one now, one in September, bring forward the end of balance sheet. That's the recalibration. And then it will be kind of data dependent from there. And it will be a communications challenge to frame this properly and to keep, market expectations kind of where you think is appropriate. We haven't seen great communication from the Fed lately. And so that could bring some volatility for sure in market dynamics.
It's really hard to argue that anybody on the Fed, maybe Bullard would be an exception, but anybody on the FOMC wants to see, the market pricing in 1 percentage point lower Fed funds over the next year. Even the most dovish and sort of cautious members of the FOMC would probably say that that's too much and the market's way ahead of itself. So regardless of the July outcome, how they sort of stick the landing to say, okay, markets, you're wrong, and we're not that going to be that aggressive because we don't see an obvious need to be at this point, versus also not destroying financial conditions, sending the dollar flying, sending credit spread wider, yield curve aggressive bull or bear flattening. There's all sorts of different ways they can get there, but they're going to have to be very careful doing it. And I think that's probably a bigger concern than the binary over whether to hike or not, or whether to cut or not at the July meeting.
Totally agree. I totally agree with that. And so it will be, hopefully the market moves with the data, right? If the data confirm that, yes, this U.S. resilience continues and maybe there's some stabilization and turn higher in the global backdrop, presumably the market would start to price out some of those cuts because they wouldn't be as necessary, and the Fed could be part of guiding those expectations away. Right now, it's early. The risks are still, pretty out there in terms of the global growth picture. We've gotten some mixed news on trade, but they don't need to be in a hurry. But I think, beyond September, depending on how the data evolves, they'll have to guide communication and expectations.
Can I switch back to labor market? We are Employ America. I'm just curious from Julia, George, Conor. Skanda gave a pitch that the labor market's weakening. He pointed to prime age. He pointed to GLI. How does that strike you? Would it be fair for the Fed to make that part of the impetus for this cut, or does that feel like it's crazy to say labor market's weakening?
I don't think it's crazy to say it. I think the case is very speculative right now that the labor market's weakening. I mean, if you've got claims around 200K, if you've got high opening rates, rising quit rates, accelerating wages, relatively low employment growth, but also very low unemployment by any measure relative to long term, unemployment rates are low. Employment population ratios could get higher for sure, but they're relatively high, especially versus recent history. I don't see how you look at that picture and have a very high conviction case that we need to, the labor market's teetering on the edge here. I think Skanda's argument that we need to shift to GLI because it does a better job of picking up turns in the economy and cyclical points where the Fed, needs to be thinking about easing or tightening in different places from where if you're looking at unemployment, inflation. I think those are great arguments and I think they're worth considering, but they're not using that framework right now. So using the framework they're using, it's really hard to look at the labor market data and connect the dots to where they need to ease because of it.
Yeah, I would agree that that's not the main argument for this move in policy. The labor market looks pretty healthy. I mean, we do see slower hiring in the sectors that are exposed to the global economy. Manufacturing hiring has slowed. Mining and energy-related sectors have seen hiring decline, seen negative jobs growth. So we are seeing some impact and an overall slightly slower pace of job creation. But it still looks pretty healthy. And again, that resilience in the domestic service sector, we haven't really seen any material cracks in that yet. It seems to be carrying the baton as you would hope it to do. So that's not the main case or the catalyst to me. I do agree that, in terms of though using overheating or a low unemployment rate as a reason not to cut, that doesn't seem like a good argument either. I mean, there does appear to be capacity in the labor market. The job growth tells us that, and subdued wages and labor share and GLI. I mean, I think all of those are valid reasons to say, again, the cost of doing this is relatively low.
Right.
Oh, sorry.
Yeah, in terms of the labor market, I would say the labor market today is better than it was 6 months ago. Maybe not the second derivative or every single indicator, but on the whole, I would still expect that it's going to be better 6 months from now than it is today, particularly if we get any kind of bounce from the global economy, to Julia's point about manufacturing and trade-related jobs. So I think Skanda's got an interesting alternative framework, but to George's point, the Fed hasn't adopted that yet. And so, I don't think they should be using frameworks they haven't told us about to make decisions.
Yet, Conor, yet being the key.
Yeah, maybe.
Skanda, what do you think? You're on mute. Sorry. Oh, still on mute. Okay, well, Skanda's figuring that out. Should we talk reaction function really quick, and then we can thank you and get on with our days? But what does this say about the Fed's reaction?
I can speak now. I'm sorry.
Okay, great.
I guess I got muted by someone else. So I think as far as just to be clear about level versus change, because I think that sometimes gets confused with this. I'm not saying, obviously we have a low unemployment rate. Claims has stayed historically low. I would generally say in terms of what the Fed's shifting towards, they're shifting away from sort of looking at unemployment versus their estimate of NAIRU towards something that's more about being averse to the risks of slowdowns and the risks of recessions itself. So it's actually more about growth stabilization than it is about a level of output that they're trying to reach or a particular output gap. Especially since like their estimates of structural unemployment have really failed them in some ways. If we think about the sort of labor market progress, I think there has been signs of slowing, not just or rather wage acceleration. If you look at wage growth, run rates on like AHE, they've generally slowed down. So we've seen average hourly earnings slow down a little bit relative to the previous like growth rates we were observing in prior months. I would share Conor's outlook itself, that especially with the Fed sort of getting more dovish, the outlook is probably going to get better now. Conditional on the Fed taking sort of the approach they're taking that should support more growth in 6 months ahead. I am more optimistic that conditional on Fed easing, we are going to get something that will buffer us against some of the global headwinds that are out there right now.
I guess in terms of my reaction function, I think that they're going to be less and less focused on the Phillips curve going forward, unless the wage and inflation data is kind of screaming, and more on the yield curve as they're, we'll trust this model even if we don't see it in the data yet. So I think the past 6 to 9 months has sort of convinced me of that, and that's how I'm going to operate going forward. If the yield curve is partially inverted and we're not seeing clear overheating, then the bias is probably more towards cutting than hiking.
Julia?
Yeah, on reaction function, I think one of the interesting things we're seeing is kind of the fruition of the argument that Janet made before she left in the speech at the Boston Fed, where she talked about, what are the benefits of running a hot labor market? And, she's very academic and disciplined, and she made it very cautiously. But in some senses, Powell is running with that argument as long as the costs, and it's a very new Keynesian argument. So even in their long run statement, the one that they revisit every January, they say, the natural rate of unemployment isn't something that monetary policy can do anything about. That's starting to change. Maybe it can. Maybe if we let this labor market go strong, then we will bring back people that left the labor market, and maybe that will bring with it some investment in labor saving capital that will help productivity. So there's more of an open door to maybe monetary policy can lead to a better equilibrium if done, if they respond sort of in a disciplined fashion to the data and read the signals from low inflation, the low labor share is telling them that they've got room to test this hypothesis a little bit further. But that is a change. That's a change in the reaction function from, a strict output gap, worried about inflation, purely thinking that the Fed is just there to kind of cut off the tails of the cycle, to thinking, maybe there is some structural good that can come from monetary policy.
All roads lead back to Yellen. On a subsequent conversation, we'll have to discuss whether or not it was only possible for her vision to be enacted under Republican appointee, or whether it would have been possible with her in the chair. George, what do you think? Reaction function?
Yeah, just real quick, I think two things. The increased willingness to acknowledge that labor share of income is very low is, I think, in large part a function of Clarida joining the FOMC, and I think his contributions in that respect go back long before he was even considered with them, with PIMCO. This is something Matt Boesler at Bloomberg has talked about, done a very good job highlighting. So, I think it's partially a change in the composition of the FOMC. Two other things. One is that I think as we move forward through time, we're going to get fewer and fewer people on the FOMC whose anchoring life event is the inflation of the 1970s. And so I think, just as a function of demographic and time advancement, you're going to have more people like Brainerd and fewer people like Bernanke, right? And the final thing I think I would add to that is that you can see that playing out in how often a member of the FOMC talks about the risks of higher inflation. I try and make a note of every single time an FOMC member speaks publicly. We get about 95% of them in our tracker for it. And I can't remember the last time an FOMC member explicitly said something to the effect of, we need to be very worried about high inflation and about runaway inflation based on our policy. That's like something that needs to really concern us. I mean, I'm sure there have been a couple of examples in the past year or so, but it's very rare. Whereas earlier on in this expansion, you know, before we had all the data around low inflation and what some people would call secular stagnation advancing, that was a real concern all the way through, whether it's political, whether it's a function of what people's life experience teaches them, whether it's just learning from learning from new information over time. This FOMC is much less worried about the downside of higher inflation than past FOMCs have been, and I think that's been really clear in the past 3 months, and it's really reflected in their reaction function since probably January or November.
Fascinating. Skanda, you want reaction function?
Yeah, I mean, I would generally second what George said about sort of we are seeing the shift in terms of like the FOMC composition itself moving towards people who I say are more sensitive to the downside risks. I don't know if less sensitive or just trying to mark down what actual inflation has been doing more recently to market, as far as the fact that we haven't seen elevated inflation in quite some time, and especially persistent in nature. So from that perspective, the Fed's, the big thing is that the Fed's, I think, breaking away from the Phillips curve and moving a little bit more towards just trying to knock out that left tail and really make sure that that we keep this expansion going. And especially with diminished policy space, that state of the world is now going to be considered more costly, as opposed to, if you talk about even 10, 15 years ago, the real scenario everyone was worried about was, oh no, we might have these sort of accelerating dynamics and inflation that the Fed is going to be in a difficult position to control. Now the worry among most macroeconomists, especially probably within the Fed, is what do we do when we're at the zero lower bound and our tools are of diminished utility. So.
Should we do one last go around? How many more cuts are there going to be? How many more cuts are needed after July 31st? And then anything else, you know, our viewers should be thinking about knowing that we didn't cover. Conor, you want to go first?
I'd say it's 50-50 for one more cut. I don't think we need it, but depending on, you know, what the market's signaling and how expensive they think it would be to walk that back, it wouldn't surprise me. And yeah, I think just thinking more about the impact of rate cuts on the dollar is probably something that we need to be thinking about more, and if it's a good idea. I actually think that sort of from a dollar targeting standpoint, maybe rate cuts do make sense, but that's a different argument for a different day.
It's one small step toward commodity, you know, commodity price targeting, and we might have to go to a gold price. Anyway, George, what about you?
I don't think they need to conduct multiple cuts. So I think we'll get one more cut. We'll get this first cut, and I think I would probably put it at less than 50-50 that they cut again. I think the data is going to pick up significantly, both in the U.S. and more importantly around the world. And so in that environment, you know, unless inflation really drops off again, I don't see how they can justify continuing to cut rates in an, you know, environment where things are going pretty well, asset prices are high, data is accelerating, and, you know, data's already been accelerating in the past 6 weeks or so. So I think they're one and done. And then, you know, at some point down the road, there will be another discussion like the one we've been having since January, where they need to discuss, you know, they start thinking about whether they need to cut rates again. But I think that will be a separate episode distinct from the one.
Anything else we should be thinking about?
I think we've covered a lot today. I don't want to plug everyone's ear full of stuff. The one other thing I would think about from a markets perspective, it's very unusual to see globally central banks all over the world, EM, DM, all sorts of different stages of cycles, all feeling really dovish at the same time, all pointing towards easing policy in various ways at the same time, basically nobody tightening policy. And I think the disconnect between that dynamic, what's reflected in rate markets, and the extreme desire to own credit, you know, very tight credit spreads, very, very quickly falling credit spreads. I think that's really, really interesting. And it's going to be something that we're going to have to look back on a couple of years from now to sort of reevaluate why it happened that way, because it's very unusual.
Julia, you want to?
Yeah, so I expect them to cut another time in September, and I think it'll probably be the right thing to do. I think some of the momentum, for example, in consumer spending, we've had a lot of volatility in the data this year. And I think if the recent data overstates the trend, just like the weakness in Q1 probably understated it. I think on balance, we are slowing. We're seeing a sustained slowing in demand growth around the world for structural reasons. So absent, what saved us from the 2015 slowdown was an epic credit boom in China and a massive fiscal stimulus in the US, neither of which we are going to have this time around. And there's no signs on the horizon that is materializing. So I think slower growth is in the cards. That's going to compress earnings. That's going to leave markets vulnerable. So I expect that the Fed is probably justified in proceeding with these rate cuts. And so I think that that's something actually to keep in mind. You could look at this, one way to resolve sort of the conundrum George is pointing to is what we're seeing is the structural slowdown that's inevitable on sort of global demographics, right? I mean, trend growth is lower. And absent massive stimulus, we're going to see much slower global growth. So the monetary policymakers are kind of smoothing that transition in a way to that lower growth path. Will that be enough? I don't know. Will there be more stimulus, say fiscal out of Europe forthcoming? We'll see. But right now, there is no imminent sort of savior to this more subdued global growth picture. So why not recalibrate policy accordingly?
Skanda?
Yeah, I would. My bias would be for another rate cut to sort of manifest itself probably as early as September, more consistent with what the Fed's FOMC members' June projections were for at least that half of the committee for about 50 basis points of rate cuts this year. I think that the dueling sort of conundrum is going to be that we're going to see the effects of some of the easing start to play out in some of the consumer data and some of the housing data. While on the other hand, I don't see the circuit breaker on the global headwinds. While we're sort of talking about this in terms of a trade war, and that's obviously one dimension of it, I think the other two things that we don't always talk about is like one, sort of China's positive global spillovers in the past are now negative global spillovers, and the Eurozone still has a fiscal straitjacket on it. So along with Brexit uncertainty. So we have those two dueling dynamics, and I'm not so worried about the fact that we're pricing in cuts across the next year and a half, because in some ways those are not just like in finance nerd speak, it's not like a risk neutral price, right? These are priced for a very negative outcome in the same way that whenever you're paying for insurance, you're overpaying for insurance, right? So there are a set of market participants who want to have exposure to a really negative view of the world as probably an insurance policy. And so in that world, 4 rate cuts happening is probably pretty safe. It probably is not anyone's baseline itself. So I don't think the Fed has any urgency to walk back the market pricing right here. If it gets to the point where the data is so good that they can do so, and they need to do so because of inflation pressures, or if they can come up with another justification for raising interest rates, then so be it. But they are not in that position right now. So they don't have any real incentive for walking back market pricing. And I think the bigger thing is we're in a demand constrained world to some degree, and the next 6 to 12 months probably are more positive because of Fed easing, but at the same time, I'm not sure I see anything beyond that until some big things shift in the global economy.
Thank you all so much. I will give my quick 2 cents, which is we need to do 50 basis point cut this meeting, another 50 by the end of the year. Then we go straight to Bretton Woods 2.0, gold convertibility by 2021, and then it's off to the races. But no, seriously, I really appreciate our guests for coming on. I thought it was fun, enlightening, hopefully stimulating. We have at JC_econ, who's criminally underfollowed, so everybody should be following Julia. At Conor Sen, at Pearkes, at Irving Swisher. Yeah, thank you so much for joining us and for participating.
Thank you, Sam.
Thanks, Sam.
Thanks.